that's the way I've kind of avoided being able to do questions about stuff like that. And I have found that it's possible alone. But no, as I said, that's too much. You have that weather video? No, but I think it's okay.
Check 1 2. Podium check. Check 1 2. Podium check. Check 1. Check 2.
part of the skit. It's a skit.
Coordination.
Okay, everyone, turn on your mics. So we're gonna, when I say I'll say, when I say in a to pause, and I'll say, think of how many handbags and shoes, and then you raise them, okay?
And then when you say handbags, I raise my like this here.
And shoes. Okay, got it? Okay.
You like my wife.
Security. Okay, got to remember.
Yeah, and I'll probably get arrested. Tell them I took your handbag.
Security. Rob. Okay. Sunglasses on. Okay, remember. You have a role there. No, you can be right here. Okay, stay on behind.
You guys have security?
Huh?
Very nice.
We have
You got a tough security guy.
Rob there. We have Belinda, Mr. Strip Matter. Oh, Sharon made it. Space out, you guys. Space out.
There's only 3 of us?
No, there's 9.
They do. They look tough. Guys look tough.
Ex-Navy SEAL.
Just need the little earpieces.
Yeah.
Belinda, could you please come to the stage? John? No, they're right there.
You want me to go bring them all, get them all in?
Someone stole your sunglasses?
No, they had them on your table. They're gone. Somebody took them.
No way. I bet you they probably grabbed just whatever they saw. Okay, if everyone could take a seat, that would be great so we can start on time. Belinda.
You've got a few at the bar, and that's about it. Good job.
We're missing one security detail. Belinda. Well, can we have a female? Come on. Come on, Christine. Now, no one can give me a hard time when people say, okay, there are more than men in dark suits in the industry. I did add some females, but they're nowhere to be seen, so no harassments there. I'd like to welcome everyone and thank you for coming to Commercial Executive Magazine's first spring forum. Before we start, I would like to take a moment and thank everyone here for their support and encouragement for the past 9 years. Now, in 2007, it was a great year to start 2 new real estate magazines with a newborn and a 2-year-old. I must have lost some marbles there, but I could not have done it without this amazing group and your support, so I thank you from the bottom of my heart for everything you've done. Now, looking at these gurus, everyone kept asking, does size really matter? Well, in a business sense, size really does matter. If you do the math, we have over $132.7 billion worth of assets represented on the stage. Now that, yes, and now that's a lot of shoes and handbags. Can you imagine? In addition, I had to hire, no, you may not. It's part of the prompt. In addition, I had to hire Donald Trump's detail to protect the panelists. Now, that's a pretty impressive group. Please join me in thanking our wonderful sponsors who made today's event happen. Raise a glass to Wilming for providing the refreshments you are all currently enjoying. These wonderful name tags by Lincoln Property, so networking is much easier. Peterson Group, Jones Lang LaSalle, Cushman and Wakefield, Hines, Parkway Properties, Wood Patel and Westpac, RSP Architects and PK Associates, CBRE, and the Rockefeller Group. Now please welcome my dear friend and the best golfer I know, Tom McDonald with Gamage and Burnham.
Mandy needs to know a few more golfers. I'm a real estate transactions lawyer with Gamage and Burnham, and I've had the pleasure of working with Grady for over 30 years. So Mandy asked me to introduce him. I'm going to borrow from an introduction I heard recently of Grady from a Morrison Institute person, and he said, if you've got a person who, when you mention their first name, everybody knows who it is, and that's pretty much the case with Grady, do you really need to do an introduction after that? Well, I'm going to do a very short one. So as most of you know, Grady is a fellow with the Morrison Institute, a professor at Arizona State University, and most importantly, a founding member of Gamage and Burnham. Mandy asked me to also throw in a couple of things that people don't know about Grady, or maybe not everyone knows about Grady. So first, inside fact. Grady still does practice. He actually does practice law, even though you see him at almost every real estate forum that there is, but he's very active, doing a lot of stuff, and a lot of stuff behind the scenes. Second thing is that a big activity and a passion of Grady's is his book club. There's a number of the book club members here, a lot of old friends, and like most good book clubs, it's not really about the books. It's about drinking. So Grady's favorite drinks are bourbon and rye. So if you want him to be your moderator, good to start with either of those. Grady Gamage.
Thanks, Tom. So Mandy, I got to tell you, the median age of that security detail did not give me a lot of comfort. On the other hand, I'm pretty sure that the median net worth of the security detail is higher than the members of the panel, which is impressive. So the conversation today was billed as being hunting for elephants. Now, I thought that meant this was about a quest for the lost soul of the Republican Party. But it's not. I'm sorry, Sharon. We should try to find it. You can help. But that's not the point. The point was to try to assemble a bunch of very large real estate companies who do business in Phoenix, who are interested in Phoenix, and to talk to them about how they make investment decisions about Phoenix. Now, if you are not interested in that topic, it's Mark Singerman's fault. He was the one who pitched it and wanted to talk about it and was convinced you would be interested in that. So we'll find out. As Mandy said, Mandy toted it up at 132.7 billion. Whenever numbers get into the billions, you're not sure how it's being exaggerated, so we don't really know. But there are a lot of assets represented by the companies here. The companies are very different. 3 of them are publicly traded. 3 of them are headquartered in Texas. Some of them are complicated interlocking webs of partnerships that probably have no interest in revealing their tax returns, even should they run for office. In large measure, what we're talking about is kind of what's happened to the real estate industry in this last wave, as many investment decisions are becoming increasingly institutionalized. So we're going to have kind of a conversation in 3 parts. The first part is about who these people are. Now, you know most of these guys, so I'm not going to spend a lot of time introducing them. But you may not know much about their companies, so I want them to talk a little bit about the companies and how their history evolved and how they operate today. The second part is kind of how do decisions get made, and as a cog in the company, do you really matter, or are you just kind of hanging out? And then I want to have each of you talk about your view of the Phoenix market and how your company views the Phoenix market and where you think it's headed. So that's the 3 parts. If one of those is less interesting, that's when you should duck out and drink and come back in time for the market stuff at the end is probably the most interesting to most of you. So for the first time through, I'll start down at the end with Brian. Brian Kearney is with Catellus. Brian has been a public employee. He's been a nonprofit development company employee. He then worked for a small local Phoenix development company, Gray Development, that some of you know, and he now works for Catellus. So he has a broad perspective of the industry and is apparently unable to hold a job for very long. Catellus is a very unusual company. So Brian, I know you haven't been there long. So you probably have no idea yet how decisions are made because they've sheltered you from that. But tell us a little bit about Catellus and how it got to where it is and what it does.
Sure. So Catellus has a really interesting history, actually. Probably unlike anybody else up here, I would imagine. They started over 30 years ago as an internal department of the Santa Fe and Southern Pacific Railroads when those 2 railroads merged. And they were created specifically to redevelop abandoned rail yards that the railroad no longer needed. And so through that experience, and as you might imagine, many of these railroads, they were brownfield sites, obviously. They were actually, in many cases, very well located, Mission Bay in San Francisco being one of them and probably one of the most well-known. And so through that experience, they developed this expertise for large-scale, very long-term redevelopment projects on large sites of, in that case, 300 acres in Austin. We're redeveloping the old airport site, 700 acres, and thereabouts. And so from that beginning with the railroad, really developed an expertise in that type of a project. And as a land developer and as a master developer. And those types of sites, as you look around the country, are typically owned by some sort of government institution. In many cases, it's municipalities. In other cases, it's a branch of the military. It might be an airport authority. In this case, it might be a university. But they began to develop an expertise and a niche and became well known around the country for these large-scale public-private partnerships that are long 10, 20-year or even more redevelopment projects, and have gone through a transition from an internal railroad department to a publicly traded company on their own, an independent publicly traded company, to being part of a publicly traded REIT, Prologis, to now being owned by one of the largest private equity firms in the country, TPG, Texas Pacific Group. So have been through a number of ownership structures, always connected either with a very large bureaucracy as a railroad or an institutional type partner in terms of the publicly traded company. So a very unique history. But through all of that, the basic Catellis team, a few people have retired, but the basic Catellis team has stayed intact. And so it's a really unusual story, I think.
Okay, Mark, this is all your fault, so you have to be really grippingly interesting. So the main thing I want to know, you work for the Rockefeller Group. Have you ever actually met anyone whose last name was Rockefeller?
Well, here's the real truth. You've all heard of this company called Standard Oil. And you recall in 1911 they were broken up by the federal government under antitrust. And one company became seven oil companies. And the ironic part about that is that it just made John D. Rockefeller that much wealthier. So he actually got richer as a result of the breakup. So fast forward now to 1928. John D. Sr. is retired. His message to Junior, John D. Jr., was give it all away. So John D. Jr. is now in 1928, understand that time frame, he's 100% philanthropic. So he's approached in New York City by the Metropolitan Opera. And the Met says, John, we've identified a piece of property. It's owned by Columbia University. It's 11 acres, and they won't sell us just a couple acres. And they won't sell anything. It's got to be a lease for 21 years. Would you lease the whole thing for us and spin off a couple acres for us? Remember, this is 1928. John says yes. He signs the lease for 11 acres at this piece of property near Central Park. 1929 shows up, and the Met says, gee, we're really sorry, but we can't raise any money. And so John D's stuck with the land. So what does he do? He's an oil guy. He doesn't know anything about real estate. So he puts together this team, and first building in Rockefeller Center comes up out of the ground, finished in 1932. Unfortunately, another little building called the Empire State Building delivered the same year. We're still in the middle of a depression. So it's a bloodbath to get tenants. Fast forward to 1945.
So, Mark, I'm hoping you're going to get up to the 1970s at some point.
Getting there.
We got ground to cover.
You asked for the story.
Okay.
You're doing great. Keep going.
Fast forward to 1945. There's a lottery to get into Rockefeller Center. There's a lottery to get into the Empire State Building. Everything's full. So the Rockefeller family just starts building as fast as they can. Fast forward to the early 90s. The last son of John D. Jr. is David Rockefeller, and he decides it's time to sell. He sells everything that's left of Rockefeller Center to Mitsubishi Estate. Who is Mitsubishi Estate? Mitsubishi Estate's wealth comes from 100 acres they bought from the Japanese government in the 1800s. And today, yeah, that's going to take a while. Today, that 100 acres is downtown Tokyo. And what their core assets are today, what's left, 30 high-rises right at Tokyo Station, and that's the core holding of that company. They are the second or third largest developer in the world. We just celebrated our 25th anniversary with Mitsubishi, and the Rockefeller Group Development Corporation is now become the growth engine for Mitsubishi. Why? They can't grow in Japan. Japan is shrinking, it isn't growing. So we are their growth engine in this country. And so that is the story of
And
Rockefeller.
so are there people named Rockefeller still involved?
No, sir, but Mitsubishi bought the name Rockefeller Group, and they protect that with everything they've got.
Wow,
That's
all
our
right. Chris Anderson is with Heinz, which you learn it's not Heinz Company, it's not Heinz Inc., it's Heinz. That's all you say, it's Heinz. And it's not spelled with a Z, that's the ketchup. This is different. So, Chris, from you, I want to know if you hang out with Jerry Heinz. Do you sit and have drinks in the evening sometimes with Jerry Heinz? And tell us about Heinz history and his start.
Well, I'll probably take a page out of Mark's book. So back in the 1920s, in Gary, Indiana, a young Jerry Heinz was born. And in the 1930s, he didn't even know anything about the Rockefeller Group. However, so Jerry Heinz, great visionary, didn't start out that way. Jerry went to Purdue, and when he got back from the war, he told me the story how he ended up in Houston, which is where we're headquartered, which I think is great because he said he got down at Purdue, he had a mechanical engineering degree, he was making a decision, he had an offer from two companies, one in Baltimore, Maryland, one in Houston, and he chose Houston because his four fraternity brothers lived in Houston and he didn't know anybody in Baltimore. So that's the reason why you make life decisions is based on your fraternity brothers. So he moved there, was designing air conditioning systems and decided to build a warehouse for his neighbor who had a small contracting company. And he did a few of those and started to make some money. And all of a sudden he learned of a group that was looking to move their headquarters out of New York, Shell Oil. And he went there. Now, mind you, the largest thing he'd ever built was 16 stories, and it was underway. It was an apartment project. So he flew to New York with his partners, and they went to the conference room, and legend goes that he walked in with a piece of a solid core door that had a brass handle, and he put it down on the center of the conference room table and said, "This is the quality I'm going to build for you in Houston if you come." And so they awarded him the job, and he got a 50-story high-rise that's now called Shell Plaza. And so I asked him, I said, what was the scariest thing that you've ever had to deal with? Was that what you were scared? He said, no. He said, we didn't know what we were doing then. He said, the scariest deal we had was the Galleria because we actually knew what we were doing, and I knew that I could lose everything and fail. So much like the rest of us that are up here in the room, that's kind of how it goes. Once you have too much knowledge, you have more fear in that prospect. But so Heinz, based out of Houston. I always get the number one question I get when I first introduce Heinz is it the ketchup company? And I say no, but we were founded in 1957, so there's our hook to Heinz.
There you go.
But it's a great firm. We're in 199 cities in 19 countries, all privately held. The decision-making process is fairly flat, but it's a great organization. Yes, I have spent time with Jerry. I've walked around with him. Probably the scariest day in my career was when he came out here recently. He's 90 now, and he wanted to come tour our Chandler project. He also wanted to come tour another project that we're working on. And I was absolutely in fear that if something happens to him while he's on my watch and he dies, I'm going to be working for Dave.
All right, Chris. So Dave Crumley is with Lincoln Property Company, which was started based on Abraham Lincoln's speculative investments before the Civil War. No, that's not true. That is not the history of Lincoln Property Company, but it's another Texas company. Dave, you all know, has been in the Valley a long time. But tell us briefly about Lincoln Property Company. And Lincoln and Heinz are both from Texas, one from Houston, the other from Dallas. And I think they're structured similarly in that they're this vast web of complicated interlocking partnerships that everybody has pieces of everybody else's deals and that kind of thing, right?
No, exactly, Grady. I was going to say we are a large interlocking web of partnerships I really can't talk about. So I was going to hand it over to John.
So we keep things moving.
No, we have. It's privately held, always has been for the foreseeable future, always will be. But it was founded by a guy named Mac Pogue back in Dallas, Texas, and we're on our 51st anniversary this year, so been around a while. He was one of the original Trammell Crow partners, and if anybody knows the old Trammell Crow, our organization set up a lot like that, where you have regional partners. We all co-invest in our deals, so that's really the structure. He started out as a multifamily developer. And really kind of cut his teeth on that, and then hired a guy named Bill Duvall, who's my boss along the way, and started a commercial division, which is what I run out for the Southwest region, which is really office, industrial, and retail. Pretty flat organization from a decision making. I've got 3 partners in Dallas that actually co-invest in our deals, and then we've got equity partners. But from a breadth and depth perspective, we have, last count, 6,800 employees. I think we're in 45 markets. I think we have 350 offices within those markets. So pretty deep from that perspective. And then we have an international group as well. But and if I screw this up, I'm working for Chris.
So John DeValley is the Liberty Property Trust guy here in town. Liberty is one of the publicly traded companies on the panel. It is a REIT. It is headquartered in some strange little town in Pennsylvania I've never heard of. Explain that.
Yeah, Malvern, Pennsylvania. So it's a western suburb of Philadelphia. So let me take you back to William Penn, who founded Philadelphia. I think it was 1710. So fast forward, Liberty is publicly traded, as you mentioned, based in Philly. Bill, we were known as Rouse and Associates. Some of you may know the Rouse name from the East Coast, pretty prominent real estate family. We went public about 25 years ago, though. So I joined right after we went public. Was pretty much an Eastern Seaboard, office and industrial, private developer, a lot of kind of big name Crow, and a lot of big names in the sort of old line family companies in the late 90s went public, as did we, kind of around that same time, and I joined then. So we have about 105 million square feet around the country in the UK. Our market cap is about $8.5 billion, depending on what the market did each day. And I run our office here in Arizona. So we're big on the East Coast, really all the way from Philly through South Florida, Midwest. I opened our offices in Chicago and Milwaukee, and came here in 2007 when it was the best market in the country, right when Mandy opened her magazine. So we're kindred spirits, because I rode that right down in about 12 months. It went from the best market in the country to, as we all know, one of the worst. So the reason that we came out here, our biggest tenant nationally is the Vanguard Funds, a mutual fund company. And in 2006, we helped them build part of their campus here in North Scottsdale. And we leased them over 1 million feet in Philadelphia and here. So as part of that process, and we'll talk about why we're here and other stuff a little bit later, but as part of, we sort of followed Vanguard here, and it was it was when we were sort of moving out of some smaller markets into some bigger markets, which Phoenix is now. And so I came here to open this office about 9 years ago.
All right, so Matt Mooney is with one of the other publicly traded companies, Parkway Properties, which has been buying up downtown Tempe, and is from Florida, right? And Matt, you will detect, talks funny. He is from a different part of the country. So Matt.
Thank you. Yeah, Parkway Properties was founded by a gentleman named Leland Speed in Jackson, Mississippi. He had built up a portfolio of assets through the 80s and 90s, and 20 years ago took Parkway public on the New York Stock Exchange. He also founded East Group Properties on the industrial side, which a lot of you are probably familiar with. And as far as Parkway goes, the company was focused mostly on secondary and tertiary markets across the Southeast, a little bit in the Southwest and Chicago, up until 5 years ago. And then we merged with a company called Eola Capital out of Orlando, and subsequently relocated our headquarters to Orlando, and really had kind of a shift in strategy, like probably everybody else on the panel. Once we got through the recession, we did some reflection and kind of recalculated our strategy and where we were really getting hurt the worst and where we could have done better, and ultimately decided that we needed to focus on a few select submarkets across the Sun Belt states, that we wanted to stay focused on the Sun Belt, but we had to be much more submarket specific and really focus on assets within the Sun Belt that were what we called strategically differentiated, or not just commodity real estate. Because where we felt like we had experienced the most pain was when we just had commodity real estate, and the only thing that you had to fight with was rate and rate reductions. And so in the last 5 years, we've recycled our entire portfolio except for 2 buildings. We have about 40 buildings today, all Class A, mostly urban infill, office product, about 14 million square feet, and we're focused on Phoenix, which everything today is in Tempe, CBD of Austin, Houston, Buckhead in Atlanta, CBD of Charlotte, and then the major Florida cities. And that has worked well for us, but it was a pretty big kind of cleansing exercise that we had to go through to kind of recycle the portfolio and get in the position that we're in today.
All right. So Jay Jimenez is the first guy we've come to who has the title CEO. So I'm guessing that makes you way more important than the rest of these guys so far. And further, he is the only person on the panel whose company is headquartered in Phoenix. Apparently, he did not get the memo that Phoenix does not have headquarters companies. So tell us the history of Alliance Residential.
Sure. Well, our roots are Texas.
There you go.
Actually, the principles of Alliance, we go back to the Trammell Crow organization, much like so many real estate companies do. And but Alliance, the genesis is 2000. We started the company. Previously, Trammell Crow, we had done some public market transactions. That's when we were starting to spin off divisions. And in the West, we did a transaction with BRE Properties. That was in '97. And one of our other principals had done Gable's IPO in Houston in '94. So we did our public tour of duty. And, we really did those transactions thinking, there's so much public equity being raised. It's really changing the landscape. They're going to have a cost of capital advantage. And lo and behold, in about '98, about a year after we did the BRE transaction, the winds of the capital markets changed again. Public companies weren't raising as much capital. The private companies started having an advantage. You started seeing LBOs and companies being taken private again, real estate companies. We started raising private equity inside of the public company to fund our development pipeline, and I think we kind of looked at each other and said, why are we doing this? Let's get back on the private side. So that was really the genesis of Alliance. There were 4 of us that started the company. We started with Phoenix and Houston offices, 2 offices. We've now got 34 offices. We bought our property management business back from the public transaction. So we started with about 200 people. We're now 2,500 people. We own about 22,000 units. We're coast to coast, not in the Midwest. We just never have really liked the growth dynamic of the Midwest, but we're in all the other major metros but for the Midwest. We do about $2 billion in production a year. In that magnitude, somewhere in the 7,000 to 8,000 on the production side. Acquisitions we do as well. Have a property management business that manages our projects, and then also a third-party business that manages for others. So we're about 90,000 units in total. That's about $15 billion in portfolio. One of the questions was our largest project, that I'm almost amazed at the size of the deals that we're doing now. It was a $500 million, almost $500 million deal in Orange County that we should break ground on late this year.
That's what, like 10 units, 12 units?
Yeah, 12, yeah. Yes, 1,200 units, has retail. Almost a whole little city.
And the pictures on the magazine were taken in Alliance's project on Camelback Road.
That's right. Yeah.
We weren't all actually there, however.
Yeah,
it's very cleverly photoshopped. It's quite well done, but fake.
We were airbrushed in, and while we're talking about that project, maybe maybe I'll get a little fun plug in. So that project, Broadstone Esplanade, right next to our offices at the Esplanade. And it's probably one of the funnest projects, I think, at the end of the day, that I've ever had the enjoyment to work on. And the reason it was fun is those locals know that that was the site that Trump Tower was going to go. And this is not a political statement, so don't throw shoes at me or anything, but Mr. Trump came in, guns a-blazing, thought he was going to ram that project down the neighborhood. They got into a battle, and the neighbors said no, and we ended up buying it from the bank, buying the land from the bank. So I always loved telling that story because I wanted to get T-shirts that said, "I made money off the Donald."
And bear in mind, Trump Tower in Phoenix would have been 15 stories. That's a tower. So Jim Mastandrea is both chairman and CEO. So clearly the most important person we've heard from yet. Furthermore, you started the company, I think, right?
Grady, I wanted to ask you, should we take a break before I start? I'll be brief. I'll start with Genesis 1 through 6. Whitestone Reed is a fascinating company. It's probably one of the most interesting ones that I've had the opportunity to be involved in. And my wife has accused me of being a serial entrepreneur. So, and I guess certain things make you qualify as that. But it's an interesting company that I got involved in 2006 as an independent trustee. And it had about 150 million in assets, which is really minuscule. It's probably one of your apartment projects. And and it had the shareholder. It was a public, non-traded REIT with shareholders who were at least 80 years old and about ready to lose every cent they had invested in this company. And so, and there were no employees. All there were assets, and not much more to start with from there. And I was invited onto the REIT to be an independent trustee to help them take it public and also turn the company around. And about the third or fourth meeting, one of my the attorney advised us. He said, either you all have to resign and you may go to jail with this person, or you have to take over the company. And if you do resign, just know all these shareholders are going to lose everything they have. I took over the company. Today we're about $1.2 billion in size. We did an IPO in 2010, which is just 5 years ago. And we've built the company around a business model that is really exciting. And what we've done is we've capitalized on two major paradigm shifts in the industry. One is that it occurred probably 20 years plus ago, and that is that many women are coming into the workplace. So they don't have time to shop during the day. Most cases, not all women, but most cases. And the second paradigm shift is that most of us, including my wife, we buy things over the internet through Amazon.com. In fact, my wife holds the honor of being the most deliveries during the day at the condominium we live at in Houston. They keep this black market bet going on. So what we've done is we've capitalized on those two shifts, saying that the retail industry is truly changing. That if you look at the malls and then going to the big boxes and going to discount retailers, they have less traffic today than they had 2 years ago and 5 years ago. And they have a lower percentage of sales because it's going through the internet. So what we did is built our model on the service side of the business. Our properties, we think of most retailers, most people in the retail real estate ownership, think about their properties as being anchored by a grocery store, by a discount retailer. We look at the neighborhoods as our anchor, and then we connect our properties to the neighborhoods. And then we work with the kinds of tenants we want after analyzing the needs of the people in the neighborhood to find the tenants and meet those needs. And a couple of properties that you might know of that we own. One is called Dana Park in Mesa, which we bought, went under contract and closed in 22 days. Market Street at DC Ranch. It's another property that we own. I think we closed out in a little longer than 22 days. And both those properties we bought were 70% occupied. Today they're in the 90% occupancies. Dana Park, we bought it with a $3 million NOI. It has a $5 million plus NOI on it, and we've had it entitled for another large addition of properties.
Let's use that as a segue to the next part. How did you make the decision to buy those? You're the chairman and the CEO. Does somebody bring it to you and say, this looks good to me, and you go, yes, and that's it?
Yeah.
Do you have to take it to a board? Are you the final decision maker?
Well, in a public company, you really have to think about transparency. And rule number one in a public company, before transparency, is everything has to be explainable, because your shareholders have a right to know, and legally you have a responsibility to know. So we were down in the Mesa area looking at one of the out parcels, which was about 30,000 square feet. My director of acquisitions and myself, I've always made it a practice to look at everything we buy before we buy it. And he wanted to show me this property, and he said, what do you think of this? And I said, well, I really like the larger one better. And about 30 days later, it came to us and said it's available for sale if we're interested. We were asked by 2 banks if we'd like to put a bid on it. We said we didn't want to be a stalking horse. And so we were assured we would not be. We put a contract in place, and we closed it 22 days later. So that, and before we close it, we do our own due diligence.
And the criteria are about its location and the nature of the neighborhood around it, more than about the asset itself?
Part of it. I mean, we do all of our due diligence internally, but what we look at is the opportunity to apply the business model I briefly described, and then the opportunity for upside. Because as a public company, we really are responsible for the profitability of the company. Let me just share with you a couple interesting numbers. Now, we began this business...
Quickly, though.
In the beginning.
In the beginning. Back to Genesis.
Just a few numbers. They're kind of interesting because we started this business... We did our IPO in 2010. Okay, so we're now talking 6 years later. For the last 3 years, we had a compounded annual growth rate of 28% in revenues, 29% in net operating income, 40% in funds from operation, which is basically cash flow, and 14% in growth in FFO per share. So it's what that really is symbolic of is the changing dynamics in the retail side of the real estate business and knowing who your customer is.
Cool. So, Dave.
Yeah, I'm here.
I saw you like gossiping, so, you know. Hey, I teach classes. I watch the students. So, you surprised us all when you bought the Lures Complex in downtown Phoenix. Historic buildings, not your typical modus operandi. That's Latin, David.
I went to ASU, Grady, just so you know. So I got that down.
So, how did you pitch that? What did you have to do to get the company interested in buying historic buildings instead of the more routine kind of assets we think of Lincoln as buying?
I'll start at the end. The net is I found capital for it. So it's, I found debt and equity. But prior to that, Lincoln had been going around the country in a few select markets and buying historic assets, mostly in Boston, did a deal in LA called the Desmond, which was the old Willys factory, which was a super cool building. But as soon as we started demoing it, it ended up on a USC most likely to collapse building in Southern California in the big one. So they ended up having to rebuild the structure of the asset, but then ultimately leased it to a full building user, and it ended up being a double. But in any event, so found out that we were doing those kind of deals, came across the Lures, always thought it was the super coolest building in town, or buildings in town, came up off market. So we had a kind of a early look at it and reached out to Invesco and said, hey, are y'all interested in doing a deal like this? They said yes, and then reached out to B of A, who's a lender of ours, and they said yes, and checked with my Dallas partners, which is a pretty flat process, and they said yes, and here we go. We're going to go buy a historic building.
Was it critical to the decision that there is additional development potential on the site, or was it underwritten as just an existing asset?
You know, it was a little bit of, we didn't underwrite any of that in our original underwriting. We had a kind of an alternate case that potentially you could do additional development, but our base case was no. And a little bit of frosting on the cake and a kind of a, potentially if we develop it, fantastic. If we sell it to somebody that develops it, it's again a nice, something nice to have, but not required.
So, Chris, our perception at Gamage and Burnham is that you really like to buy properties that are screwed up and have a lot of problems, for which we greatly thank you. Is that true? Do you look for properties that have some hair on them, some challenges that may dissuade others?
It's my Lawyer Full Employment Act that I'm trying to work through, but I don't know. It's just kind of one of those things that those properties are sometimes most interesting and they create the most value, but you got to have patience. So trying to convince your organization to have patience sometimes through those processes is interesting. A lot of lobbying, a lot of those things. So again, hanging out with lawyers, you learn how to. It depends on what the definition of is, right? So anyway, no, in what you're talking about is Chandler, of course, and Jeff Miller, who's in the crowd here, certainly knows there were days when I was high-fiving in the morning and crying in the afternoon because that project had just so many challenges to it. But for the most part, yes, we look for those projects that are not always what I'd call middle-of-the-fairway type of things. Because again, sometimes the smaller groups can move a little quicker, can do things a little faster, can do things that we necessarily
So you
can't.
find a project like that has a lot of challenges, like the Chandler project. How many people do you have to get to approve that before you can do something like that?
It's actually fairly flat. I have a regional CEO in Houston, and then we have an investment committee that's made up of 7 members, and you pitch there. And I literally can call the investment committee members, and you sort of internally lobby that process. But prior to me landing here, it always seemed like the organization was this huge thing that couldn't make decisions. And once you're a partner, you find out that it's actually fairly flat. Similar to how Lincoln operates. You call your partners, tell them what you're doing, give them the sort of case, and move along. So it actually moves a lot quicker than you think.
John, another publicly traded company, what do you have to do to get a project approved that you want to move forward on?
You asked me earlier, when I got here earlier today, if that was like good or bad, and I said, just depends on which day you ask me. So before I answer your question, can I just bust Dave a little bit because you wanted a little interaction?
You bet.
Well, I got debt and equity, so I had to build it. I mean, that's when it's time to run for the exits. Okay? I grant you bought it. You bought it. It wasn't spec development. I know.
John.
Okay, I was embellishing.
Who's building like 10 spec buildings over across the river from me?
Well, I got equity. I got to spend it.
Yeah, right. Yeah, it's stockholder equity, right?
Not true. Not true.
Yeah, really.
Intensive demand analysis with my brokerage partners. So it's funny, to answer your question though, so 18 years ago when I joined Liberty, we were a small public company. I literally wrote offers for stuff that I wanted to buy, and I faxed them to our head of acquisitions back in Philadelphia. Like, that was the extent of I kind of like that. I think I can make this work. That's what I did. It's not that way anymore. It's a far cry from that. Now, okay, I have the benefit compared to some of my counterparts up here. I don't have to go find equity, and I don't have to go find debt, right? But I do have an investment committee that's a pretty rigorous process. So what I do is I have a strategy for this for each place I've been, and they buy into the strategy. Like, it's a big presentation, like a very thorough, what submarkets we want to be in, what product types we want to own, and how we want to go about it. They buy into that, okay? So everything that I send up to them, whether I want to break ground in this building, or I want to buy something, or I want to buy some land, we've already kind of halfway done because, okay, this is consistent with what you've told us, and we all bought into it. So it's really more about the underwriting then at this point, and it's 5 guys on our investment committee, and they meet every week at a minimum. So it's actually pretty efficient, but sometimes with some of my people that I work with, they're like, you got to go to Philadelphia, you have a 1-hour meeting and it takes 2 days from here, really? I'm like, yeah, but I don't have to go find partners, and I don't have to do some of this other stuff. So it's pretty efficient, and as long as I have my ducks in a row, that's generally how it's supposed to
So Matt, another public company similar?
Very similar. Yeah, so we have a market leader in each of our markets. So here in Arizona, I fill that role, and I'm kind of constantly working with our chief investment officer to run ideas past him. To John's point, you're working with your investment committee, but the key for us being publicly traded is we're already kind of projecting to Wall Street what our strategy is, and you've got analysts who have made recommendations to buy your stock based on a certain set of parameters that you operate within. So we know, for example, in Phoenix, there's a list of 35 or 40 assets that we would want to own. Ultimately, the box is really not any bigger than that. There's only specific submarkets where we would want to own assets or develop. And so, you know, you've bought into that strategy as a company. You've hopefully had Wall Street buy into it, and then you're just kind of working to fill that box.
You want to tell the rest of the guys what's on your list,
No,
so they're
no.
aware? Yeah,
We don't.
to bid up the price
We
a
don't.
little
Yeah,
bit.
we think they should stay out of Tempe as much as possible.
What if you
Getting tough there.
find something that's not on your list? Do you just walk away, or do you? And it interests you. Do you take it?
No, for sure. And so you know, you've got to continue to grow. And I mean, you know,
I asked because I own a building in Tempe. You might want to.
yeah, let's talk after
All right,
me
all right.
and not these guys. But you know, we'll absolutely look at it. I mean, that's ultimately the key for us to continue to grow. You get into these submarkets and have a heavy presence there. There's only so many assets that you can chase, and so we are always evaluating other markets, evaluating other submarkets where there could be opportunities, and maybe there's, you know, trends that have happened, and you're watching really ultimately tenant demand to try to project, you know, where the job growth is going to be and where the tenants are going to go.
So, Jay, your multifamily is a different market niche than most of these guys are in. I mean, they may do some of that, but that's your thing. Is it a different process to decide when you want to buy a multifamily site or buy an existing multifamily complex?
You know, I think it's probably pretty similar to the rest of the private, particularly those that came out of this private partnership model. And we have no outside investors in the business. We have no debt at the entity level. So it really is just we've got 53 partners of equity in the business that are all active in the business. And so it's this regional, we've got kind of a divisional process where we've got market leaders in each market, and they're really tasked for going out and finding the opportunities and executing on the opportunities. And so the decision-making process is really decentralized to them. They'll come back to us on what I call kind of a progressive at-risk. Look, I want to spend X dollars to go into due diligence on this opportunity. And then once we get through that, then progressively we're going to spend more as we go through the entitlement process, and ultimately we're going to close the opportunity, close the land, and start the development opportunity. So they're coming back to, there's three of us on the investment committee, again, all active in the business, no outside investors. So we really are able to stay pretty in tune with what's going on and the opportunities as they progress.
And so your equity partners have placed money with you, and you get to decide where to deploy their money.
No,
you don't have to talk to them individually.
Well, we have different types of equity. Some of it discretionary, some of it not. So typically, if it's not discretionary equity, then we're going out and finding the debt and equity for those projects as we're surfacing the opportunities, and they get to say, you know, yay or nay, we're gonna do that deal or not. Discretionary capital, yeah, that's how it works. Basically, the investment committee is making the decision whether or not to invest in the opportunity on behalf of the discretionary capital that's been raised.
Mark, how do you get a decision made at the Rockefeller Group?
Well, the first thing I'm going to do is get these guys in front of Rockefeller, tell them how these words efficient and easy and smooth, you know, it takes me 2 months to get the right to make a deposit on a piece of property. I mean, it took me 6 years to get them to understand what a non-binding LOI is.
You wrote it in English, that's why.
Yeah, right. I mean, you know, changing Rockefeller is like literally moving an aircraft carrier. And it's, you know, they are so set in 85 years of history of doing high-rise office and huge projects. I mean, David Rockefeller did Embarcadero Center in San Francisco. You know, these mega projects that they do. And so it's been a real education for them to understand that in Phoenix, you can't pre-lease buildings. That if you want the lease, you have to build it on spec. It took me 6 years to get them to understand that. And then the first building I got done when we went to investment committee. And again, we have a write-up about this thick to get to investment committee. And so by the time you get there, it should be, pretty much a rubber stamp, because everybody's looked at it. I mean, 30 people have weighed in on this investment memo. But this time, we're talking about a spec building. And it's a knockdown, drag-out argument. I mean, we're literally screaming at each other over the phone. And we won.
You are aware this is being taped, right?
I'm hoping Rockefeller's listening. But we finally get it done, and we build that building, and we lease 92% of it within 5 months. The next building I wanted to build on spec, took me 10 minutes. The third building I'm building on spec took me 15 minutes. So it's nice to know that you can actually move the aircraft carrier sometimes. And we've actually got them to diversify. I mean, if you'd asked me 5 years ago if Rockefeller would ever be doing suburban 2- and 3-story apartments, I'd say you're out of your mind. But that's what we're doing, and now we're actually expanding that as a welcome diversification.
Wow. So, Brian, do you have any clue how decisions are made at Catellus? Have you been there long enough to really? And if not, I will tell you that the next question is, tell us about getting a decision made at ASU. Or your
there you go. Well, Grady, I'm going to answer your question, but I'd like to answer my own question first. Having gone first with your first question, I'm jealous of the fact that several people here took us back to colonial times and took us back to the Depression. So I'd like to go back to ancient Roman times. I did a little research today on Catellus. So just so you know, a little history about the name. I am going to get to your question, but you might find this interesting. It all comes back to me, which is kind of the important thing. So Catellus, the name. So CA is California. The company's based in Oakland. And so there actually was a contest a number of years ago to come up with the name of Catellus when it was spun out of the railroad. So some employee said, okay, CA, we're based in Oakland, so CA. Tellus, as you may not know, was the name of the goddess of the earth, all right? And it's a Latin common noun for land, territory, or earth. This is very important research. Refers to the guardian deity of Earth and by extension the globe itself. But most interestingly, what I found out was that they sacrificed pregnant cows for the benefit of Tellus back in ancient Roman times. And there were actually people who helped with that. Let's see, what do they say? 12 male helper gods. So metaphorically speaking, it seems I must be a god as well as one of the helper gods, right? So anyway, that was my research.
And that's how decisions are made. There's a cow that's sacrificed to you.
So educational.
No, any of that. To your question, it's actually, we're owned by one of the largest private equity firms in the country, $70 billion in assets. But Catellus, as I said, has operated under different ownership structures as an independent company for more than 30 years and has much of the same management structure in place over that period of time. And so we really do continue to operate as an independent company. We put our own capital in the projects. While limited experience in the decision-making process on big deals, I have some. And my experience is that there's a lot of discretion given to Catellus as an independent entity from TPG. There's certainly a board of directors. Certainly TPG sits on that board of directors, and we need to get approval for major investments. But the management team has been in place a long time. Catellus itself is not a big company, frankly, from an employee standpoint. There's about 60 employees in the country, around the country, people like me who start deals on their own here. And so it's kind of a lean.
So is the ASU deal typical in that you are the master developer, but it is likely that other stuff that actual vertical development is going to be done by others? Is that a typical Catellus deal?
Yeah, very, very typical. So at our core, we are clearly a land developer, and virtually all of our deals start with us in that
And the
capacity.
decision to go after the ASU Stadium District was made before you got
Yeah, it
hired.
was
You got
made
hired to do that
after
deal,
they were
right?
awarded.
So now to do individual deals within the Stadium District, do you have to get ASU approval on every deal, or is Catellus going to be able to make individual deals?
No, so the structure of the Athletic Facilities District, these are going to be 99-year prepaid ground leases with ASU. And so ASU is the ultimate lessor. One of our roles is not only to market the individual development sites, but to negotiate the leases on behalf of ASU. So ultimately, ASU is going to approve every deal. There's no doubt about that. Now, we've got a plan and we've got a strategy, big picture strategy. We've got a business plan that we're going to submit every year. But yes, they do approve every deal.
So Grady,
Okay.
can I just say that, it's a good thing that Catellus is private, because if they were public after that intro anecdote, the stock might have gone. Okay.
All right, since you volunteered, I'm going to ask you next.
Okay.
So, John, how do you view the Phoenix market at this point? What interests you? Where do you think the market is headed? And when you have a deal and you take it up the chain at Liberty to Pennsylvania, how do they view Phoenix at this point?
Well, that's a really good question, and actually several of us on this panel have talked about that before. I mean, the short answer is pretty positively right now. I mean, we had 60,000 job growth, March over March. I'm from Wisconsin. I think that would be a decade of job growth, right? So I mean, we're doing things are going pretty well here. What people on the East Coast and decision makers, since most of us aren't headquartered here, don't want to see is Phoenix in the Wall Street Journal for the wrong reasons, right? So I think everyone here should be cognizant of that, meaning, SB whatever. We have an SB something and on the Wall Street Journal, it's never a good thing. So we need to be, that's really not what it's like to do business here. So our guys get that though now. So we're here because it's one of the top 10 metros in the country, and we don't think development has gotten out ahead of demand, and there's some temperance in the market, and we want to be in all the top 10 cities in the country. And so, generally it's viewed pretty favorably. Coming out of the crash was bad. We were able to fill a lot of space. We bought a lot of stuff coming out, and now we're just pretty much developing because we're not paying 5 caps for stuff.
So are you looking at the same kind of stuff that Liberty has done in the past? The one that people drive by and see, obviously, is Tempe, where your sign is up there big, and drive time has moved in now and so on.
Yeah, well, we have some more run to go there. We're looking at another development opportunity in a different submarket on the office side, and we broke ground on a park out west, an industrial park, a couple of weeks ago, where we're going to build 1.5 million feet. We're building some spec buildings out there, so pretty well set for now. I think we got a couple years left in this market, and we'll probably be buying again when things slow down a little bit. But for now, we think there's some good run left in development. So, housing isn't really taken off yet, so there's some still lift in our market, I think.
So Matt, I was going to go to you next, but we know your answer. You have a secret list of 40 properties. That's all you want. That's all you're interested in. And if they come on the market, you're going to buy them, right?
Yeah, exactly. That's all you need to know.
How is Phoenix viewed at this point?
Yeah, I think I would echo a lot of John's comments. We're very excited about it, and I think probably the most exciting thing to us is there's some real signs of maturation. When I started covering this market with Parkway, it was during the last cycle, and it was just build a suburban building with a surface park parking lot and lease it to a mortgage company, and that's how you made money. And so clearly that wasn't a healthy recipe for Phoenix long term. And so we think when you look at some of the things that have happened in terms of attracting jobs, the work that the ACA and GPEC have been doing to really reverse the impression that people have of Phoenix, and that it's just all sprawl and residential related job growth, and the quality of the jobs that we're attracting, that's really encouraging. And then on the real estate side, in terms of taking advantage of that job growth, a lot of focus on urban infill development. I mean, when you look at what the majority of us are working on today, it's infill sites. It's not just kind of sprawl and suburban product. We think that's really good, coupled with the fact that the financing on the office side has been really, really difficult to get if you're trying to do anything speculative over about 25 million feet. So while demand is really growing, there's not this concern of a supply bubble. So we're excited about it and hopeful that that kind of maturation process will continue.
So I'm going to keep asking you this question, but I want you all to think about an additional thing that Matt's comments bring up, which is for generations, we have measured the success of the Phoenix economy by annual new housing starts. That's it. That's the metric we use every year. Maybe we should change to something else. Anybody got any ideas for that? Let me know. But Dave, talk about the market and how you think people...
I was actually going to answer. I say we should do that as annual multifamily starts, because Jay is just saturated everything.
Well, and I'm going to ask him whether multifamily's saturated when we get to the market down there. Dave, what's your view of the market? And
I want to say it's nice that Chris actually got off his phone to answer that question. In any event, sorry.
Touche.
Yeah, no, so, and this is at a risk of sounding like Tony Lydon over here, but we're tracking, I actually looked at our big tenant list before I came. We're tracking 43 big tenants in the market, some here, some new, above 25,000 square feet. So I would say, I think Matt would, and I think everybody would up here, the big tenant activity in our marketplace today is as good as I've seen it in, scary to say, my 30 years in the business. So that's fantastic news. I think, obviously that's relating to job growth, so that's great news. The under construction, we've got a couple million square feet under construction, a big chunk of it. John and Ryan and gang are doing at State Farm, so it's already leased and absorbed. So that helps that number. So I don't think we're getting over our skis on the development side. Financing is extremely difficult, as I would attest. So I think from that perspective, it feels good. What we talked about earlier was, we all feel like we're in the fifth inning of a 9-inning ball game. I think the rest of the world feels like they're in the seventh or eighth inning of a 9-inning ball game. So what we think in our marketplace, because we were late starters or late comers to the party, it doesn't really matter. I mean, if the rest of the world says, from my perspective, says, the game's over, the game's going to be over. Yeah. So we're late in the cycle.
Chris, you agree with that? And how many big tenants are on your list, and can you see his list next to you?
Well, first of all, he wanted to know what I was doing on my phone. I was actually texting my guys Dave's list. And then I realized that this is actually Chris Tosey's list. Yeah. And there's really nothing new in the market.
It's actually Chris Marshallton's, but that's
all right. Anyway, no, I echo Dave. I think we are still kind of, fifth, sixth inning of the market here, or even use another analogy in the real estate clock, we're kind of about 10 o'clock right now. But much like Dave said, we're all subject to what the capital markets are saying out there, and if they believe Phoenix is redlined and done, then it'll be done. But right now, we have not seen that. We've actually seen them look more at Phoenix now because the coastal cities have basically topped out in terms of value. And so a lot of my colleagues that are in those markets now are just harvesting what they have as opposed to looking for new deals. And so that capital is getting recycled into the growth cities of the Southwest. I actually saw a stat today that the Southwest is actually accounted for 50% of the population growth in the country in terms of new population growth. So clearly people are moving out to the Southwest U.S. still, and so we should start seeing some growth, hopefully in residential, but for the most part, I think Phoenix is in good shape right now.
So Heinz is looking to do more stuff, even as you're selling some of the stuff you have, like some of us know about. But
yeah, I mean, certainly we're always looking at transacting different product types at different times in the market. If it makes sense to sell, we sell, and if it makes sense to hold it, we hold it. We're no longer the company that just builds something and holds it forever, but really we look at timing the market and understanding, when's the most optimum time to sell, and if we need to, we finance things to hold through recessions so we don't lose buildings. And so far, it's worked for us.
Mark, now that you can get your deals approved in like 8 minutes, have you got a lot of stuff you're looking for? How do you feel about the state of the market in Phoenix at this point?
I think the business is almost fun again. So it's, it's been a long dry spell before, there were the fundamentals of supply and demand made sense to build anything. But at the risk of sounding like my brokers, I just delivered an 86,000 square foot flex office building, and it's too small. There are at least 4 office users out there today that want bigger spaces. Total, there's about 1.2 million square feet of office demand out there that my brokers are tracking, again, at the risk of sounding like Phil Breidenbach, my broker. But you know, if we're, I'm not so sure we're all that far in. You know, I've been in this market since 1979. I've watched these boom and bust markets forever, and I thought that's the way it was always going to be. But this recovery is definitely different. We have broken the mold, and this kind of even flow, if you look at the pipeline of supply that we have, it's nothing compared to what we normally do in our recovery. And for most of us on the panel, that's extremely good news.
And is that the result of the way decisions are made by the kinds of people on this panel? Is it the result of the market becoming more concentrated in larger entities and lenders being more careful than the Wild West cowboy developer days we were used to? Is that part of the change?
It's a very good question. And I have, in my observations, every recovery from a recession since I got in the business in the mid-'70s is the industry's become more and more institutionalized. And especially this last one. You know, you're either really small or you're really big. The guy in the middle, the middle tier developers really got hit hard. And so guys on us up here, we're fortunate that capital is not an issue, usually. Rockefeller's an all-cash developer. We took a land position out here in 06 and 07 and suffered through the recession, but we didn't have a lender, so we still have our properties. And now we're starting to build those, and we're seeing demand. But more and more, it's the big players doing the deals. And either you're a small developer partnered with an institutional capital player, or you are an institutional capital player.
So, Brian, you were nodding your head. You have a big land position that you don't really have a lender on either. You have a sort of rolling option deal for shorthand purposes. Do you feel good about that? I mean, do you think the market has enough room left to run, since you haven't started anything yet, that you can get it going?
Yeah, I mean, I think big picture, I think there's a lot of questions. I mean, there's a lot of variables out there. You know, what are ultimately the Fed's going to do with interest rates? What's a new president going to mean, whoever it may be? You know, there's tremendous uncertainty out there right now. The positive thing, I think, is that there has been essentially a regulator on the market, as we were talking about prior to starting the discussion, that has kept the boom-bust cycle, I think, from taking off like it normally does. And part of that, you know, it really is, I think, largely the capital markets. But we're close enough to what was, you know, damn near a depression that the memory is still there, and it's kept, you know, it's created this sort of, I don't know if it's natural artificial regulator that has kept us from the boom-bust cycle that Mark was referring to that we typically have. I think Phoenix, Greater Phoenix, I should say, is and always has been a very sub-market specific type of place. And you know, you look at the West Valley, there's not a lot that's happened there yet. You look at the multifamily world, for instance, in downtown Scottsdale and the 101 corridor and Tempe, and been a lot of development that's happened there. So things are very sub-market specific here, and I think that always will be the case. But in general, yes, I think the places like where we are very well positioned given the assets that they have already in place, the foundation from which to build. You know, Ryan's and Sunbelt delivering 2 million square feet of a institutional tenant like State Farm at your doorstep. Can't help but lay a great foundation for the future.
So Jim, you made a fairly compelling case, I think, about the possibility of repositioning retail. There's been a lot written about sort of the end of retail, and your point is it's not ending, it's changing. But Phoenix is often viewed as one of the most over-retailed cities in the country in terms of acres devoted to retail uses. Do you think there's room for more of what you're doing in Phoenix? Are you bullish on Phoenix as a place to do this kind of repositioning?
Let me give you just a slight overview first. We track 6 markets: Houston, Dallas, Fort Worth, Austin, San Antonio, and Phoenix. And one of the indicators that I've watched being in the business for a long time, not as long as Rockefeller, but a long time, is that we watch housing starts. and I wouldn't delink housing starts. You mentioned earlier. And if you follow housing starts, every time the country has approached a presidential election where there's a potential change in a candidate or party, you start getting a headwind on housing, and we're seeing that now. Usually it slows down, and then about 18 months afterwards, it picks up again. And the entire market works like that. So if we go through our market, we have 4 deals we could buy right now in Phoenix. Well, right now, we're the top 3rd or 4th owner of retail space in the city. Our objective is to be in the top 5 in every market we're in. We're seeing the retail space get pricey, which really answers your question. It's getting very pricey. And that tells me that it's time to really be careful and watch that housing sector of this market, because it impacts every other sector. You also have this huge bubble of millennials coming into the market, and they're not buying. They're looking at micro apartments as opposed to full-fledged apartments, as you know. You're probably doing micro apartments. So you have an entire different group of people coming through, which they're going to change the way real estate is looked at. So when we look at Phoenix, we think we're towards the top of the market in our segment of the industry, the retail segment. When we look at Houston, there's 20,000 vacant apartments right now on the market, and offices are starting to choke. And you're finding people looking to discount their existing space for lower rents because there's so much available. So Houston is kind of, the bubble's stretched and almost breaking. Dallas, it's close to it. It's getting to the point where it's ready to bust in terms of overall. And Austin is just going like gangbusters. It's like Scottsdale on steroids. It's amazing. Then you've got San Antonio, which is a military town, which is also growing at a rapid rate. So when you take the economy overall, and it's a public company, we can choose, do we want to invest in Austin this year, or do we want to invest in Phoenix? Do we want to invest in Houston? What we're doing is we have, for a relatively small REIT, $1.2 billion I think is small, we have $500 million of an unsecured line of credit with the best banks in the country. And so we're geared up for that 18 months following the presidential election. We think there's going to be a lot of buying. We came into Phoenix in 2010 and we started buying. Everything we bought, we're probably at an average of about $140 to $150.
And does it make any difference who gets elected to that analysis, or you think
it
that's
doesn't
treatable?
make a difference. But then we look at if you have a Democrat elected, then you look at door A and what are your options? And if you have a Republican elected, you look at door B. And just one example of the criteria we look at, door A would probably stay in floating rate debt. Door B would fix in as much debt as we could.
Huh, interesting.
So we look at things from an economic perspective and where the markets are.
So Jay, that was a good segue to the multifamily market. So are we going to reach saturation in Phoenix soon in the multifamily market, or do we have a whole lot longer to run?
I actually am pretty bullish on Phoenix, and a bit of the reasons are what's already been mentioned in the other sectors, which we were late to the party getting restarted. Certainly a lot later than Texas or DC or some of the markets, Denver, that held up better during the recession. One of the reasons why we had rampant overbuilding in the single family space. I was thinking about the retail guys looking at rooftops. We probably should have been looking at rooftops, but only from the perspective that we were creating excess inventory that ultimately was going to compete. Now you've got a single family rental industry that's competing with multifamily. So we kind of created this oversupply and had to work through it before we could get restarted. I think that's particularly true in the suburbs. That seems to have stabilized. And certainly the development initially you saw in the urban cores, in the Biltmores and Scottsdales, North Scottsdales, Tempe. And that's what popped first because it didn't have as much competition from the single-family overbuilding that, again, became a rental residential unit and competed. So I'm pretty bullish on Phoenix overall. It's one of the only markets that we are active in that we're not quite back to peak production. Most markets are way past peak production in this cycle relative to the last cycle. Phoenix is not yet. And I think there's been a lot more discipline, certainly, as we know, on the single-family side. So we're not creating more excess inventory. So I'm relatively bullish on Phoenix.
All right.
Multi.
So I want to go to a few audience questions. We have a couple of minutes for that, but I want to ask if anybody had an answer to my different index. Jim thinks single-family home starts should stay part of it. Chris suggested multifamily starts. Matt, you're the one who set me off on asking this. You got a different metric you want like thrown in as to the test of the economy?
I'd probably say job growth or maybe consumer spending, but if for sure not 06 single-family home permits.
Yeah. Anybody else got a
unhealthy.
metric, Mark?
Yeah, I think it's job diversification. I think from what I've seen this economy do, and I think it's an underappreciated attribute that Phoenix has is just how diversified the economy is, and how much more concentration of software and tech that we have that we don't get credit for. And
I saw a troubling statistic from ASU this last week, though, about how median incomes have fallen because of the loss of construction jobs, many of which were higher paying than what's replaced them. So that was depressing. I tend to agree that diversification is a good thing. But all right, anybody questions from the audience? We can do a couple questions. We have time left, or you can go eat and drink and network. That was not a prompt that you're not supposed to ask questions. Feel free. Anybody? No? Mandy, you want a question? No? Or you're saying wrap it up? Okay.
I have a question.
Okay. Jim has a question.
Yeah, I have a question for my colleagues on the panel here. Is in Phoenix, there's been an enormous number of single-family homes that have been bought by some of the large opportunity funds, maybe $1 or $2 billion worth of single-family housing, which is held up in a rental pool now. What are your thoughts when those homes are released in the for-sale marketplace? And what's that going to do to
I actually think that's a good thing. You know, you had this disparate market of all these individual owners that, you know, really couldn't professionally manage a rental pool of housing. So you had institutional capital come in. I think it stabilized prices. I think they will be more apt to hold longer term than individual owners that would have otherwise, you know, maybe dumped on the market. And I also think by being professionally managed, you know, we look at it as, again, an alternative or competitor to multifamily. Well, a professional institutional manager is going to look at it like a REIT or like we would and saying, you know, we're going to provide good service, we're going to spend the money to maintain, and we're going to push rents. And we're going to try to maximize our NOI. So I think it's a really good thing.
So, Jay, do you think millennials are going to get back to buying houses at the same rate as previous generations, or do you think they're staying in your apartments for a long time?
I think, well, I don't necessarily think they're staying in our apartments longer because their lifestyles are changing. They're committing to marriage later, particularly guys. You know, we have a fear of commitment. So we're up to like 29 as the age for first-year marriages. So why people buy is space and price, and you know, they'll move to the suburbs. So I don't think that's gone forever, but I also think that, you know, the cheap money that was fueling a lot of the purchases, I'm kind of hoping that doesn't come back. So I think there's a permanent aspect that now we're probably a little bit below the home ownership rate that we probably will stabilize to, which long-term is more like 64. We got as high as 70. But you know, I do think this more urban trend and rentership is a permanent trend. But I still think that ultimately buying will be part of the equation as people age.
All right. Well, let's give the panel a round of applause. Thank you, guys. That was great. Any of you who want to hear more details of the history of the Rockefeller Group or others, they'll be out in the lobby. Thanks, everybody.
Let's speak Greek history.
Let me rewind.
This year.